Hi, I'm David Libman. Today I'm going to walk through the Investment Primer Part 3. We're going to do a deep dive of a financial analysis of a typical rental property. We're going to focus on a multifamily property. So let's look at the components that make up a detailed financial analysis. First and foremost, we have to get a deeper understanding of the income and expenses coming off of a property so that we can determine how much money the property makes, essentially the profit. Although in real estate we call that NOI, or net operating income. Income minus the expenses gives you the NOI. Next, we need to make a few assumptions. In order to run a financial analysis, any kind of financial analysis, you always need to make a few reasonable assumptions. So we need to evaluate what's going to be the cap rate, what's going to be the LTV, what's going to be the DSCR ratio, and a few other ratios that we just need to make some general assumptions based on the markets that we're in, the type of property that we're looking at, and the type of lenders that we think we're targeting. Starport will be able to help you out with some of these figures during, or if you were to run a scenario, but in general, so too will the realtors or just your local knowledge of the market. You'll get familiar with these general terms and you'll tighten the assumptions up as you go through the process and as you go through diligence, getting closer and closer to an actual loan. Next, you need to know the purchase price. The borrower that you're working with will probably know either a firm number that he's already put a contract in on, or his estimates of where he thinks he can buy the property. But if he doesn't have a deal yet and he's just really fishing around and still doing research, you'll be able to give him with some estimated cap rates for the type of property that he's working on, and within a range, you'll be able to make that assumption of the purchase price based on a cap rate as well. Finally, we're going to look at the lender loan test so we can get an assumption back of the envelope, kind of thinking of what the range of lenders and loan amounts should be. And we're going to put our lender caps on, and really begin thinking like a lender would. We're going to look at the source and usage so we can take a deep look at how much money the property is going to need, this project is going to need, and where that money is going to come from. And finally, we're going to want to get a good understanding of what kind of investment returns this property will throw off, not because this is an equity deal, we realize that we're involved in the debt world, but because we want to make sure that the borrower is going to be able to make money off of this deal, and therefore it's going to be a very viable, substantial deal that has likelihood to go forward. And if it's not, you want to be able to provide some great advisory, some great consultation to your client and point out to them why you think this property, this project, this deal has some real concerns and that he should take a deeper look at it. Let's jump in. This is a financial model. We built this in Excel. And don't worry, we'll make this available to you if you find this will be helpful. There are an endless number of different financial models available online. A quick search at Google or at Etsy, for that matter, or Pinterest, will yield literally hundreds of different individual companies that make different versions of spreadsheets. I still continue to make my own because the ones I find online are either too complicated, don't do what I want them to do, or really address the needs that I have in making my own spreadsheet. So I find this one very simple, very basic, and very helpful, and hopefully you will as well. Let me move myself out of the way. So this is going to mimic the components that we just looked at in the same order, starting at the top with the income statement. This is step number one. I'm going to look at the income, I'm going to look at the expenses, and I'm going to calculate an NOI. Now, my mentors used to always tell me, and I'm going to tell you, don't let this get complicated. At the end of the day, there's rental income and there are operating expenses. And break each one down and just focus on what you're trying to do. So, rental income. In multifamily, there are a number of units. Let's say in this case there were 10 multifamily units. Each unit generates a certain amount of rent. You can capture that rent. It could be a rent roll. It could be individual units that you just multiplying out. But whatever it is, don't let rental income get confusing. So we have rental income, plus you have other income. What's other income? If we're dealing with multifamily, other income might be late fees, might be some additional fees involved with maybe there's a parking fee or a pet fee, whatever it might be. It's all typically related to rental income, but it's still categorized slightly differently. You want your rental income, that one line, to just purely be the rent that's on the lease that you're collecting. Everything else can be in other income. Now you could break down other income into a couple different lines. I choose to lump it all together. That gives you your total income from rental activities. Then you have your vacancy and credit loss. This is a typical figure. Very often, lenders will put a common number in here. They won't even think about it. Doesn't matter what you tell them. They might just put in, doesn't matter, it's 5%. We take 5% off the top on every property, just assuming you're going to have 5% rental vacancy loss. Now, if you're a strong borrower and you have a lot of experience, you can push back on this number and say, no, listen, I know my business. I have a certain way of operating it. Look at my other properties. I'm always getting 3% or 2.5% or whatever it is. If you can substantiate that, that's great. If not, the lender's typically going to throw 5% in here. What is vacancy loss? Well, look, if people pay with their credit card, and that's more and more common online these days, you're typically going to take 3.5% right off the top. If they pay with an ACH transfer, there might be another fee off the top. And finally, there are just people who aren't going to pay. And so you're going to get some skips here. And if you average out the skips, that might also become a vacancy or a credit loss. And you're eventually going to come to your total income, which on a commercial real estate property we call EGI, effective gross income. Let's look at the operating expenses. So I've included here some of the basic categories, but the operating expense list could get very long and very detailed. Let's just look at the basic categories. Real estate tax. This is typically taken from the county. You can go online and find records that will indicate what the county taxes have been for a period of time. It depends in your local area when those new numbers come out and when they get assessed every year. But you need to understand what period of time is this rental tax information from? Is this the current year? Is this last year? Is it half of last year and half of this year? So you need to understand when the rental income coming is from. Similar with property insurance. Is this the previous owner's rental policy? Or is this the new policy that you're taking out on the property? You need to understand that, because if he's buying the property for an increased purchase price, let's say the previous owner held the property for 20 years, and now you're coming in, and your borrower is coming in and buying the property, he could be paying substantially more, which could significantly increase the property insurance premiums. So you need to understand what period of time and what policy he's looking at when he's writing down the property insurance. Property management, typically this is between 3 and 10%. On a smaller property, it's typically going to be larger. On a larger property, it's typically going to go down to 3 to 4 to 5%. That's just standard numbers. Now, what's that percentage of? That's a percentage of EGI. So very often a lender is simply going to say, oh, you've got a 15-unit multifamily, you've got a 100-unit multifamily. We're going to assume that property management is 5% of your effective gross income. So it's really important that you have an effective gross income number that you can rely on, and then you can make property management would be. On smaller properties, it gets more difficult, or in some ways it gets more subjective. Why? Because you're not hiring a third-party property management company. You're probably not hiring any staff, whether it's a third party or your own staff, because the property can't afford it. So who's doing the management? And management, we're talking leasing, we're talking hiring, firing, we're talking cleaning, whatever it might be that's involved with the property. Typically that comes out of management, and it's very often the owner. And so, look, property management is an expense for the property, and it should be included, because the lender wants to include it, because if the lender had to take over the property, remember, on a non-recourse commercial property, the lender is considering the fact that he might have to take over the property in order to recoup his loan. So if the lender had to take over the property, I promise you, the lender doesn't have any staff that's going to be able to go manage that property. They're going to hire a manager. And so therefore, they're going to build in some number to make their assumption of what it would cost them to manage the property. But if you are a smaller property, by smaller, I mean probably less than 50 units, because once you get less than 50 units, you're unlikely to have enough income coming off the property to be able to afford any kind of staff. You really get a good understanding of who's managing it and how is it being managed. That's property management. And at that point, it's probably not a percentage of EGI. It's probably just a flat figure that the borrower can substantiate. Either it's because the previous owner had somebody who was part-time going into the property and managing it, and this current owner is just assuming it, or the new borrower has a way in which he plans to manage it and he can substantiate and support that. Repairs and maintenance. Every property needs repairs and maintenance. It's often a very expensive number. Sometimes it'll be done per unit. It can encompass multiple different things. Different parts of the country, different age of the property are all going to have an impact on what your R&M number is, or what your repair and maintenance number is. If you think about it, if you are in a colder climate where it snows, In the winter, you are going to have a lot of damage and a lot of repairs and maintenance just needed because of the wear and tear from the weather. If you are in a hurricane zone, you might have due to typical storms that come through. So it really does depend where you are. These numbers will vary. If you're on an older property, you're going to need more repair and maintenance than on a newer property. Very often on a brand new property, you might have very little repair and maintenance for the first year or two or three. But this is an important number, and a lot can go in here. So you need to take a deep look. What's inside repair and maintenance? Is the borrower going to include any kind of staff, like a maintenance man? Is he inside of repair and maintenance, or is he inside of property management? So you need to understand what's inside of the repair and maintenance number. Utilities, electric, gas, perhaps oil in some older Northeast properties, landscaping, and even trash removal. You need to determine what's going in here. Some people include trash removal in utilities, some include it as a separate category. Some put landscaping as utilities, some don't. Some properties even have landscaping and some don't. So you need to get a good understanding what's inside of utilities. Regarding the standard which you're thinking of, which is electric, gas, and water, sometimes the tenants pay it. So you need to get an understanding of, is this all owner paid, meaning the landlord is paying all the utilities, or are some direct to the borrower, or are some what's called a RUB system where they're reimbursed, some kind of reimbursement system where where the owner operator does pay the electric, for example, but every month he goes in and charges a certain amount back to his tenant. So you need to get a good understanding of that. And if there is a RUB system, if there is some kind of reimbursement, you need to figure out or determine, is that reimbursement money coming in at the income level, so it's above the line, it's part of EGI, or is that reimbursement money considered an offset of utilities and comes in on the expense line? Professional service, this is typically accounting, maybe some legal work. Don't forget, if you have evictions or you need to write new leases, you may have legal work. If you have, and every month there should be some kind of accounting on the property itself. Sometimes the accounting and the bookkeeping could be done at the partnership level. So even below the line, below the income off of the spreadsheet. But if you think about it, really a property does need some kind of bookkeeping. So there probably should be an accounting line in here as well. Professional services might also include IT services. Um, that's important to figure out if there are computers at the property, some kind of Wi-Fi, who's maintaining that? Is that part of repair and maintenance? Is that part of utilities? Or is that part of professional service? Capital reserves, often known as CapEx. There are certain amounts of money that are ordinary and recurring items into a property. Those are typically called capital reserves. Anything that is once in a while, like carpets, you're going to redo carpets once every 5 years. Roof, you're going to redo once every 20 years or whatever it might be. That's typically below the line and off of the spreadsheet as a capital asset. But you should understand what's a recurring number that's recurring every year of typical things. They're not your typical repair and maintenance, but there's some amount of money that every year is done for capital reserves. The lenders will automatically typically include a reserve number. It might be per unit. So 250, 300, $350 for every multifamily unit just as a reserve. What's this for? It's for the fact that in 5 years you're going to need to redo carpets. And in case your borrower was not sophisticated enough to put aside money every month, the lenders want to know that they've been keeping a pool of money called CapEx, cap reserves. Sometimes the lenders will actually require this to be part of the mortgage payment. Other times the lenders will require this to be kind of separate from the mortgage payment, but kept in an account at the lender's bank if the lender is a bank. So just get clear on whether this particular lender is going to include capital reserves. I think it's good practice anyways. As a borrower, as an owner operator, you should be aware that your property will need longer term repair and maintenance numbers. And those like carpets, like roofing, like landscaping, not day-to-day landscaping, but repairing the walkways, repairing anything that goes into the property, the driveways or the pavement, all that should be put aside as capital reserves. It's good, prudent management to include it. And if your property can't afford it, it's a big problem because it's going to need to come out of somebody's pocket in a few years from now. At the end of it, you're going to have a total effective gross income. You're going to have a total operating expense number. Subtract one from the other, and you now have NOI, or your net operating income, essentially your profit from the property. Um, and hold on to that number for just a second. On the spreadsheet, we're looking at we're looking at this line number 21, and this figure is roughly $8,000. Now we're going to jump down just a few lines down here, skip over the debt service and the tax flow for just a minute, and let's figure out that this period in time where we ran these numbers, was this 1 month? Was it a full year? Was it the trailing 12 months? You'll hear these terms thrown about, oh, it's the trailing 12 months. What does that mean? Well, it's right now, the borrower is trying to borrow this money in September. So last year's numbers, end of the previous year, probably aren't as relevant because you've had almost 2/3, if not 3/4 of the current year, where you have seasonalities in the expenses and in the rent rolls. The rent roll has been increasing every month. The expenses have been changing, likely going up, because expenses always seem to go up. So you're going to want to take a more recent look at these numbers. So you might take the trailing 12 months. It's a full year, but at least you get the full cycle of a year involved. That's the most common. That's what I always prefer to look at. Some owner-operators will play around and begin to look at shorter periods in time. Why would they do that? Because it's most likely that in the most recent period in time, your rents are higher than they were a year ago, right? Rents are always going up. And as the rent rolls maturing throughout the year, right? Tenants are moving in, tenants are moving out at different periods of the year. More recently, the more recent numbers are generally higher than the previous numbers. So very often you want to take the most recent period of time, even trailing 1 month. I've seen owner operators use. The challenge is, if you're going to want to take the more recent period of income, then you need to match that against expenses. It would be unfair, and the lenders will catch this, if you try to use the most recent rental income against last year's expenses, right? Last year's expenses are less than now. Current income is higher than it was previously. So you're taking the opposite extremes of both in order to try to maximize proceeds. And that's good. That's what you as a broker and as a borrower want to do, but you need to do it in a way that you can support it with strong arguments. There's nothing wrong with it, but you need to be able to support it because the lenders are going to fight you on it. And then most importantly, you need to be able to be aware of every line item that's in here. When was it taken? Last year's, this year's, last month, this, whatever it is, just be able to document it as you're going through it. And the borrower should be able to do that as well. Very often, the borrowers you're dealing with are going to have this on the back of an envelope, literally on a piece of paper. So just have a conversation with them. Where'd they get the number? I don't care if it's on a piece of paper or on a fancy spreadsheet. How do they get to their numbers? As long as you can support it and you can make the argument to the lender, you'll be okay. Bottom line is, you need to come up with an annualized number that represents a full year. That's our goal here. So if it was a trailing 3 month, you need to annualize a 3-month period by multiplying it by 4 to get to 12. If it was a trailing 6 month, you took a half a year, times it by 2. Whatever the period is, you just want to be consistent. Next, we're going to look at assumptions. So we talked about a couple of these, and for our model, we only need 4 or 5 here. We want to take in, what's our estimated purchase cap rate? What should properties like this in this particular location be? What should their cap rate be? Interest rate. What do we think is an approximate interest rate for the type of lenders that we think we're targeting, and the current period where we are in the world, and what we think the interest rate should be. DSCR, what we think is a reasonable DSCR for this type of a property and this kind of a borrower. Max lender loan to value. Again, what are typical LTVs for this particular property in this market? And closing cost, what we want to estimate our closing costs are going to be as a percentage. I've run in here, interest rate and cap rates are going to vary completely, but in general, you're going to run on a DSCR, you should probably run with a 1.20, unless you know specifically that the lenders you're going after are going to offer or be willing to go lower than that, i.e. 1.15. And similarly with a target LTV, 75% is probably very reasonable. Again, it depends on your asset. Construction properties are probably a little lower. Maybe stabilized grade A or class A properties could be a little bit higher. In closing cost as a loan amount, larger properties will be very close to 5% or even less. Smaller properties are likely 5% or even more, simply because the closing costs tend to be somewhat fixed. Legal costs, accounting costs might be somewhat fixed relative to the loan amount. Other costs are not. If you have title insurance, if you have any kind of prorated property taxes, or I'm trying to think of other items, but they might be less on a smaller property. Appraisal is going to typically be less on a smaller property than on a larger property. With your assumptions, you can now take a look at an estimated purchase price. Again, The owner might, or the borrower might come and tell you, here's what I'm buying it. Here's the contract I have on the property. That's the end of it. You don't need to play around with an assumption right now. You could just plug in whatever the purchase price is that he's telling you or she's telling you. But if they don't know, then you need to make an assumption of what kind of a range you would expect for this kind of a property. What's the next step is why we need all these numbers, because now we want to put our lender thinking cap on, and we want to try to get a good estimate of what we think the lenders would reasonably be able to offer us as a loan amount on this property. I'm not talking about going to hard money. I'm talking about a reasonable lender for this kind of a property. An ordinary lender, a market rate lender, let's call them. That's probably an important term to think about, a market rate lender. What would they typically do on this kind of a property? So we're going to look at two different tests, and we're going to take the lower of the two. The first test is very simple. It's the LTV test. You take the purchase price of the property, multiply by the estimated LTV, and you come up with a loan amount. The second test is the DSCR test. We're going to back into a maximum loan amount based on the DSCR. So we know that the annualized NOI, which we calculated up above on line 26, we know that that number was 95,980. We estimated a 1.20 debt service coverage ratio, and therefore I can back into what's the maximum debt service coverage, what's the maximum mortgage payment we could have. I've used the term in this model called ADS. That stands for annual debt service. Mortgage payment, ADS, debt service means mortgage payment. So now I've backed into it and said, okay, the maximum mortgage payment this property can have is roughly $80,000. Now I've got more assumptions. What's my estimated interest rate and what's my amortization? Amortization, you could always estimate 30 years, but you need to know what estimate interest rates are. And with this, you can then run a calculation. If you can look up here in the formula chart, it's a standard calculation called the present value. So if you went to Excel and you looked for this formula, PPMT, you could look up the present value, this formula, and if you're just plugging it in, you can see which field the formula is going to use. It's going to use the mortgage payment, it's going to use the interest rate, and it's going to use the amortization to calculate what is the present value of the loan amount. And you can tell right away that this number is built upon the variables that we've chosen. If I change the debt service coverage ratio and or the interest rate and or the NOI and any of the income or expense numbers, this number is going to drastically change. So it's a moving target, and as you get further down the loan process, you'll tighten up these figures. For example, if you were to go to Starport and run a scenario, you could get some feedback of here's the different interest rates that you see. If 3 or 4 lenders responded to you, and each one gives you their different interest rate, if they're all over the place, from 5% to 15%, that's not going to help you very much. But if you find a range, 7.25% to 8.25%, okay, you could probably take 7.75% and estimate this is a good approximation for the kind of interest rate that we should be using. Same thing with debt service coverage ratio. If you got feedback from a couple different lenders in the area that those lenders that are offering these interest rates would also require this kind of a debt service coverage ratio, now you have your assumptions, and that will get tighter as you go along. Now I have my two tests, and I can see which number is lower. And in this case, it's the LTV test. So that is the figure that you would go with in this model. We're going to assume that the lenders are going to look at both models and take the lower number. Next, step number 4, I think we're on, sources and uses. We want to put all these figures together and begin to figure out how much money we're going to need in order to buy this property. So I know my purchase price. We estimated our closing cost based on the 5% variable or assumption that we made. So I can see that our total cost of this project is roughly $1,260,000. If there was a renovation budget, you'd have a budget in here. If there were any other uses of money that you might have, you would put them in here as well. There could be not a renovation budget, maybe a small, $10,000, $15,000, $20,000 budget based on these normal numbers, just to assume some additional capital. And then your sources. Well, where are you going to get the money? Well, we're estimating a senior loan amount, and this is where I plug in these two tests to make the estimate of roughly $900,000. And the difference now between my total cost less my loan amount is the amount of money I'm going to have to come up with out of pocket in order to fund this entire project. I'm not going to say just the purchase, because the purchase is a little bit less. I'm taking it one step further, being a little bit more sophisticated and say, in addition to my purchase price, I'm going to have some closing costs. So that I'm including that number as well to figure out and determined that this owner-operator is going to need roughly $360,000 cash at the closing to buy this property. Now, next thing I want to look at is, well, if he made that investment, what kind of investment returns would he get on day one? So we could look at that. We could say, okay, now $360,000. The before tax cash flow is $20,481, and we can calculate out that on day one, before he improves the property at all, before he renovates it, before he raises rents, just today, the day he buys the property, if nothing else changed, he'd make 5.7% on his property. So you might be asking, where do we get this before tax cash flow number? So for that, I'm going to go back up towards the top, towards our first section of income statement. We calculated out the NOI, it's roughly $8,000. We now calculated out with our debt service coverage tests. Well, let me back that up. We now have our loan amount. We took the lower of the two tests. We have our loan amount. We have our interest rate. We can now calculate out using a different formula called the PMT formula, very common formula. We can now calculate out what the actual mortgage payment would be. So that's how I can get to this. I can back into this now. So my 8,000 minus my 6,200 gets me roughly $1,707 of profit. This would be monthly. I took the 1,707 and I annualized it down here. If you look at this formula, 20 is just C23 times 12. I took that before tax cash flow monthly number and annualized it to come to my annual figure. And that's our entire analysis. I've gone through this rather fast, but you can obviously go back over it, keep the model in front of you, and take a look at how these numbers flow. The differences here and where things get complicated are in your income and your expenses. It's the most important thing. You always go back to the fundamentals. Just be very clear on how you derived or how you calculated out your income and how you calculated out your expenses. You can play with the numbers however you want. You just have to be able to defend them and support them to the lenders. The lenders are going to want to know during due diligence, show me all your utility bills, show me your rental leases, show me a copy of every rental lease, show me a copy of your property insurance policy, show me your repair and maintenance bills for the past 12 months. They're going to want to ask for everything. Again, we mentioned in the primer part number 2 that because this is a non-recourse loan, the lender's only recourse, their only way to recap any kind of problem, any kind of loss, would be to go after the property. They're going to do a deep, deep dive on this property. So that's all going to be part of due diligence. It'll be really important for you to prepare those numbers now because you just saved a lot of hassle later. And that is that's primer number 3. So I hope that was helpful. And if you have any questions, need any additional help, we are always here to help you at Starport and to answer any of your questions to make sure that you're comfortable in now entering into the investment loan business.